So hi again. In today's video, I want to introduce some basic concepts about trading. So personally, I don't trade with real money. I always trade with virtual money. And I thought that I would introduce some basic concepts in order to acquaint you with what's occurring in the news, if you yourself want to understand the concept of trading. So let's start. So as an introduction, you always want to buy a low valued stock to be able to sell them at a high price so that you can lock into a profit. So when you trade, you want not just to make money consistently, but you want to get on a systematic approach. So traders usually base themselves on technical and fundamental analysis. I shall show you a little bit more on technical analysis later in this video. We want to make low risk and high profit, so the risk to profit ratio should be good. What's the aim and objective of trading? You want to make a large gain if it is a winning trade, and you want to make a small loss if it is a losing trade. So in order to make a small loss in the losing trade, you need an effective risk management. You need to know how much risk you're being exposed to. When we talk of the risk exposure and that you want to make a small loss in a losing trade, you take an insurance policy in order to protect yourself. So in this case, we're going to talk of a stop loss order, which defines the maximum amount we are willing to lose if a trade goes against us. So next part is I'm going to define what's a stock exchange. So we often hear the word stock exchange, but many of you guys might not know what's the proper definition for the stock exchange. So basically, it's a market mediating between buyers and sellers on different assets. So the assets involved are stocks, options. When we talk of options, there are calls and puts, and futures. So that mediation between buyers and sellers follows the law of demand and supply, which is a basic economic law. So how a company raises money by offering part of their shares to the market and selling them to the public in an IPO. So this is how a private company becomes public. So the public becomes a partner in their company according to the percentage of their holdings. Now I'm going to give you some examples of world exchanges. You have a New York Stock Exchange, the Nasdaq. Now, there are some key terms, key concepts that you might come across when you're reading any financial news. The first one is a stock split. So a company decides to split every share in two or more shares. I'll give you an example. I have set 1 million shares valued at $500 each. So the market capitalization will be 1 million times 500, which is 500 million in total, which needs to be raised. And I go for a 2-for-1 stock split. That becomes 2 million shares valued at $250 each. So my market capitalization still stays 500 million, but the price of each share has been halved. So what's the objective behind is that the stock is more affordable to the general public. It has climbed down from $500 to $250. And I'm also raising liquidity because more people are able to buy my share. The next is a share repurchase. That is, the company buys back some of its own shares from the marketplace. And the third one is a secondary offering, a company deciding to raise additional capital by offering additional shares to the public after the IPO. Now let's jump in some technical analysis section. So basically, we deal with line charts. So you can see what color do I put it? I put it in blue. You can see that these here, the up and down movements, are basically stochastic movements of the asset. Okay. And this is here the bar chart. That's the opening. I'll tell you. The stock opens at the red point here. This is the opening price of the stock, and this is the lowest price it gets during the day, the lowest price movement, and this is the highest price movement, and the stock closes here. So in terms of, I have open here, I have closed here, this is my high, and this is my low. This here I've converted it into a candlestick chart. I'm just going to show you how a candlestick chart looks like. Like I've explained, the stock opens this side, it closes here. This is the highest price movement, and this is the lowest price movement. So when it's white, this means that the closing is greater than the opening, so therefore we have a bullish market. And here the closing is less than the opening market, so my market has opened here. This is my highest price movement, this is my lowest price movement, and it closes here. The opening is less than the closing, which means that there has been a decrease in the price movement. Okay, so this is how the candlestick chart looks like. The white ones are the increasing price movements, and the dark ones are decreasing price movements. When I'm going to make a video on the Investopedia stock simulator, the increase in price movements is going to be green and the decrease is going to be red. That's a point and figure chart. Not very, no, we don't use it so much. And we don't use scale a lot either. Now the volume. This in any technical analysis, you're able to see the volume here in this side. We say if volume increase and price increase, these are positive combinations. More investors are buying the financial instrument, and they are doing so at higher prices. So therefore, I will predict a bullish market. What's a bullish market? Is that I will buy at low and be able to sell at high in order to lock in my profit. If the stock price rises while the volume declines, fewer market participants are willing to buy that stock at the new price. So therefore, the price is decreasing. I will short the stock. What's a trend? A trend is a long-term pattern of movement in a particular direction. We have uptrend, price going to higher highs and higher lows. Forces of demand exceeds forces of supply. A retracement, which is a reversal in the movement of a security's price such that it is counter to the prevailing longer-term price trend. A downtrend consists of lower lows and lower highs, supply exceeding demand. A support is a price range in which buying activity is sufficient to stop the decline in the price of a security. And a resistance is price range in which selling activity is sufficient to stop the rise in the price of a security. We can see support and resistance if I have the opportunity to show you in the Investopedia stock simulator. A change in polarity principle. Once a support level is breached, it becomes a resistance level. The same holds true for resistance levels. Once breached, they become support levels. That's for the trend. Chart patterns. We have two types of chart patterns that we'll talk about here, which is the reversal pattern, a type of pattern used in technical analysis to predict the end of a trend and a change in direction of a security's price. A continuation pattern is a type of pattern used in the technical analysis to predict the resumption of a market trend that was in place prior to the formation of a pattern. Reversal pattern, we have a head and shoulder pattern. So I'm going to draw it for you. You see a head and shoulder here. This is a reversal pattern, which will mean that my price is, I'm predicting that it will go down. So therefore I short. Now if I want to talk about the inverse head and shoulder pattern, so it's an inverse no, so let me just show you. The inverse head and shoulder pattern is here. Okay. This is the shoulder. Okay. That's the head. And that's the shoulder here. Okay, this is the inverse head and shoulder pattern, so therefore my stock is going up. Okay, this is an inverse pattern. Reversal pattern, I also have double top. Okay, where there are two tops, double bottoms, there are two bottoms, triple tops, triple bottoms. And now we talk of a continuation pattern. So the first one is the triangle pattern. Okay, I have ascending triangle as shown here. 3 triangles here. So this one is an ascending triangle because I have a price going up. And I have descending pattern here. And then we have a rectangular pattern. Okay, this is a bullish rectangle. And the first rectangle is a bullish rectangle and the second one is a bearish rectangle. You have flags and pennants to be continuation pattern. Okay. Now we have technical indicators. The technical indicators, if you are a newbie, it will be more easy to base your predictions based on technical indicators. So first you have moving average, okay, which is the average of a closing price of a security over a specified number of periods. A golden cross, where a short-term moving average crosses longer-term moving average above it. So usually this signals for a bullish trend. that is a price increase, and you have a dead cross. Short term moving average crosses from above a longer term moving average to below it. This signals for a bearish trend, that is price decreasing. Okay, be careful about these. Okay, so I have here a 60-day moving average in dotted and a 20-day moving average in the line. Okay, at this point here, what happens at this point, my 20-day moving average okay, what happens at this point, my 60-day moving average crosses the 20-day average from above, so therefore it's a golden cross. Whereas here, my 20-day moving average crosses the 60-day moving average from below, so we call it a dead cross. So that would signal being bullish, and that would signal being bearish. Now we have technical indicators, which are price-based indicators. You have a Bollinger Bands moving average plus a higher line representing the moving average plus a set number of standard deviations from average price, and a lower line that is a moving average minus the same number of standard deviations. Okay, so you have here your 60-day moving average in dotted, and you have those two lines which are plus minus 2 standard deviations. The 60-day moving average is being bounded by those two lines. I'm not going to do momentum oscillators for you. I'm going to skip the relative strength index. I skip that too. Okay, this one is nice when we talk of MEC, moving average convergence divergence oscillator. Here you have two lines, which is the MACD line and the signal line. When the MACD crosses from above, you call it bullish. Okay. And when it crosses from below, you call it bearish. Okay, and then okay, I'm going to skip the sentiment indicators. We skip that too. So you need to be able to recognize the cycle. Okay. In the stock market, you will see that there are different cycles which are being observed. So one of them being the Kondratiev wave, which is a 54-year economic cycle. And then you have the 18-year cycle. And then the decennial pattern. And you have a presidential cycle. So while you're watching any market trend, you need to know that markets are really volatile nowadays, especially after we've been hit by a global pandemic. We also have a Ukraine-Russian war, which makes people sentiment extremely which make people's sentiment impact a lot on the market. Okay, you need to know that the market's volatility is is mostly because of how people feel, what are the people's sentiment. And then you have the Elliott wave theory here, which are market waves following pattern that are ratios in the numbers in the Fibonacci sequence. Okay, this is a bit about the Elliott wave theory, where it follows a convergence ratio of 1.618, which is the golden ratio. Speaking about the golden ratio, there are theories that the Egyptians used the concept of golden ratio to build the pyramid of Egypt. So if ever you have some free time, you can research on that. And we close on the intermarket analysis. So the intermarket analysis is a field within technical analysis that combines analysis of major categories of securities, namely equities, bonds, currencies, and commodities, to identify market trends and possible inflections in a trend. Okay. So we shall close this first part here. I want to make another video in order to explain to you a practical approach of trading. But before that, I'm going to touch a bit on call and put options for you, because I'm going to cover that in the Investopedia stock market simulator. So a call option is the right to buy an asset, right, but not the obligation. At a certain time in maturity. So the call option, the price generated is the maximum between the difference between the stock price and the exercise price and 0. So here I have the profit here. Yeah, I have ST here, and so that's how the call graph looks like. And the put option, it's the right. So I'll start exercising. It's good to know that I'll start exercising my call option the moment it hits the the strike price. Right, but not the obligation to sell the asset. At time t. So how am I it going to look like? I'm just going to change that a little bit. It looks like this. So the payoff is given as exercise price minus the strike price. As soon as it reaches ST, my payoff is 0. So yeah, that's for the options, but I'm going to do like a little trading demo on the Investopedia stock simulator so that you can understand how it's done in practice. Yeah, so that's it.